And now it's time to introduce Zoe Whitton, Head of ESG Research at Citi and Board Member at the Investor Group on Climate Change. Zoe leads Citi's Asian ESG research team, advising institutional investors globally on issues such as climate change and the energy transition. After serving as a youth delegate to the UNFCCC, Zoe studied environmental economics and policy at the University of Queensland and the University of Oxford, and worked with the Oxford Smith School and the Stockholm Environmental Institute. She later worked in management consulting with Port Jackson Partners and in investment research with Bank of America Merrill Lynch and Credit Suisse. Zoe contributes to the broader conversation in Australia through her roles on the board of the Investor Group on Climate Change and the Centre for Policy Development, and as an observer to the expert coordinating group of the Australian Sustainable Finance Initiative. She also acts as a mentor for the Energy Lab Cleantech Innovation Hub and is a co-founder of Women in Sustainable Finance. A trusted commentator on climate and energy, Zoe appears regularly in the Australian and international media. Welcome this afternoon, Zoe.
Thanks so much, David. I know you guys are having lots of conversations from a number of different angles today. I've heard Amanda talk about the report in the past, and it's an excellent piece of work. And I know there are a lot of different angles to this conversation. The angle that I can bring here and that I'm going to talk from today is really very much just the investor angle and the investor side. So I'll tell you in a minute just what we do and how we do it, so you know where we're coming from. But I should say that in all of this, I'm not a local government person. There are many vagaries of local government that I don't fully understand, but I am a finance person and I'm particularly an investor person, and I spend a lot of time in that conversation, particularly in Australia, but also in the Asian region. And so that's the angle that I'm speaking into this from. So I'm going to make 3 points and then go on to just a quick chat about what we might do next. I'm going to try and keep it pretty snappy. And the 3 points I'm going to make are, firstly, investors are extremely interested in financing a transition and everything to do with it, and more broadly, sustainable development, which includes the social side of development as well. Secondly, investors are looking for investments and partnerships which can allow them to do that. And that might seem like a straightforward proposition, but sometimes there's actually quite a bit of innovation going on there. And thirdly, the question of how do local governments fit into all of this? And that will be, I think that answer will be obvious to many people, but nonetheless, it's worth talking through, and there's still a lot of development to be done in the Australian space there. And then on the point of what to do next, I'm just going to talk a little bit about the key challenges that are at least coming up on our sides when we think about local government and subnational government generally as part of this conversation and part of this transition. So on the first, investors are extremely interested in financing a transition at the moment. And many of you will know this, many of you, we may actually have a number of investors on the call, but many of you will have had those conversations, you'll be in them and you'll be very familiar with this. So my apologies if I'm telling you things that you already know. But many of you will be familiar with the rise of responsible investment and what is broadly called ESG. What we do is we advise institutional investors like super funds, like pension funds, like sovereign funds, and also big fund managers on how they can think about things like transition, how they can think about things like climate change, and how they can think about social issues as they relate to their investments. And many of you will know that those investors increasingly do what is broadly called ESG, but is actually just investing in things other than just return, or paying attention to things other than just financials. But many of them increasingly do it because they can make money from it. So investors are interested in a transition because it's going to be important for returns. Many investors do it because their stakeholders would like them to. Their stakeholders find it very important. In Australia, the average investment end stakeholder is a person with a superannuation plan. And increasingly Australians are interested in seeing their investors or their super lean into a transition. And thirdly, investors, particularly in Australia, particularly really big investors, often care a lot about systematic risk. So they are interested in issues which threaten the health of their portfolios at large, which might not pose a threat within 5 years if you're particularly optimistic, but absolutely pose a threat within 10 years, and certainly within a number of decades. And so there's an increased concern for systematic risk. So that's why investors are increasingly interested in this conversation about transition. Another thing to note about that interest in transition is that the activity has historically been a lot about disclosure and a lot about understanding risks. So when you see the conversation between investors and companies, it's often very much focused on what can we know about a company that will let us know that the risks are being handled appropriately in that company, that they're thinking about climate change properly, that they're thinking about sustainability or social issues properly. But over time, the interest investors has moved from being about risk control and is now about achieving outcomes. As people have got more serious about climate change, and also as climate change has become more obvious, the focus of investment activity is increasingly how do we actually get a transition to happen, and how do we put our money there in a way that gets the outcomes that we need. And at the moment, they're particularly concerned with the green recovery. So particularly concerned to see that some of the investments that we know are going to be made in order to get things back on the road after COVID, if there is such a time, making sure that those investments are put together in a way that makes them useful in 5 years' time, 10 years' time, 15 years' time, and certainly avoids locking us in to a sort of industrial arrangement in the future, which makes things more difficult rather than easier. So that's just the first point, that the investors really that we speak to, and we speak to a lot of investors, are very, very interested in getting involved with financing a transition. The second point I want to make is that they are looking for investments and for partnerships which can allow them to support transitions directly. Now, a lot of you may be aware that there are lots and lots of efforts emerging to do what we call taxonomize finance into bits which support a transition, bits which are green and bits which are not. Taxonomize is a horrible word, which we have come to use as a consequence of a piece of European regulation. But nonetheless, what investors are basically doing is trying to divide up the real world and say, well, these bits of the real world that we finance are technically green and technically in line with the transition, and those ones aren't. And so we're going to think about how much of our portfolio sits in different types of assets according to that taxonomy. Now, the big example of this is a thing called the European Sustainable Taxonomy, which is basically a categorization of activities which has been made by the European Commission, which investors in the region are being asked to use to indeed categorize their portfolios. And so, 5% of the portfolio supports a transition, or 10% of the portfolio supports a transition. And the purpose of that is to try and get investors who say that they are investing sustainably to put a bit of proof behind it, and to say, I'm investing sustainably, 30% of everything I invest in is actually completely transition supportive, not just transition aligned. And so the European Sustainable Taxonomy is a really good example of that effort to taxonomize the real world into different types of activity, which allow investors to know what they are investing in. It's also a driver of investor interest in that activity, because they have to report against it, European investors and anyone who sells into Europe, in the next couple of years. And so they have a very acute interest in trying to now look at the world through a different lens and understand which bits of the world might be transition aligned or transition supportive or not. And it's worth mentioning that in Australia, we have a thing called the Australian Sustainable Finance Initiative. Many of you will be familiar with it. And it too is working on thinking about a taxonomy and taxonomizing assets in Australia to try and understand which ones will be in line with the transition and which ones won't. So there are lots of other standards. The climate bond standard is another example, but there's been this kind of proliferation of that effort to taxonomize the real world and think about, where do I want to invest? Now, in Australia specifically, there's activity even beyond that taxonomy type activity. So we have a lot of super funds at the moment pledging alignment and making financing commitments. So CBUS are an example. They've had a commitment for quite a while. Hester and First State, high profile examples of super funds that have set targets in the last month. But there is a really strong interest overall in trying to understand where investors can invest that will allow them to be transition supportive. So that's the second point. And the third point, how do councils fit into all of this? Well, firstly, I don't need to tell any of you, or local governments I should say, that much of the activity that local governments are responsible for can be very relevant to a transition. So this obviously varies by the arrangement of local government in a region, by the size, by how much activity is packaged up in the local government unit itself. But it includes activities like waste treatment, like water treatment, particularly transport, localised energy, efficient buildings, ecosystems, and also building resilience. And obviously many of those are prominently featured in the recent report. So you can kind of see those different areas of activity coming up in the different jobs footprints, right? We have, on the issue of waste, is an issue that we've done quite a lot of work on in the past. And the interesting thing about the waste issue is that the key crux of that issue actually sat at the local government area. How to negotiate the change in policies offshore that were affecting the way that local governments had to deal with waste treatment was very much a question for local governments. And so we had a lot of investors who were very interested in that conversation and were saying, for the first time in some cases, we really need to engage with the local government level now in order to grapple with this issue and in order to get involved here, which was new for some of them. So there's a huge amount of activity which happens in Australia at the local government level, which is really, really pertinent to a transition. Resilience is one particularly, which I might get to later, but is particularly important. Now, there is an obvious connection between these types of activities and investment demand. So much of the activities that a council undertakes, if you think about them as being in a sustainable form, so sustainable waste management, sustainable water management, renewable local energy generation, sustainable buildings, are the types of activities that investors want to finance. And you can see examples of that at the sub-national government level in Australia, state governments generally. Victoria obviously was the first to issue a green bond back in 2016. Since then, QTC and T Corp in New South Wales have issued green bonds as well. And the proceeds for those tend to be the things that we've just spoken about. So waste, transport, low carbon buildings, local energy development, all stuff which local governments do quite a lot. And Auckland City Council actually also has issued a green bond, which is a $350 million green bond, NZ, which is dedicated to the same types of outcomes. So there's a very obvious kind of fit between the interests that investors have and the types of activities that councils are naturally engaged in. Now, I said I'd make 3 points and then move to a question, which is what to do next. And this is where it all gets a little bit more exploratory and a little bit less precise, but nonetheless, it's worth talking about. The really big process and question, which we are going through at the moment and asking ourselves at the moment, is with respect to classification. So how do we take the activities that are already done or the activities that may already be underway and think about them as financing opportunities for investors, particularly for investors connecting with projects on the ground. An example of this effort in process is the Climate Bonds Initiative's yearly report on infrastructure in Australia, in which they basically case all of the infrastructure that is done, that is planned, that's in the pipeline, and kind of scratch their chins and go, you guys could issue some green financing, whether it's a loan, whether it's a bond, whether it's a social loan. There's all this great infrastructure that you could tag into this type of finance. So that's a really solid example in Australia of an organisation attempting to sort of start that classification and keep that classification moving. But we see it beyond Australia as well. So our team in the US have done quite a lot of work looking at the municipal bond space in the US. Obviously, it's a different council financing landscape there, and so it's not directly comparable, but nonetheless the hypothesis that they started with and that they've published on has really been a lot of what councils do is increasingly sustainable, and if not sustainable, certainly has social and sustainable development outcomes. How can we take that activity and attach that to investors who are interested in supporting it? And so that's for us, that's a very much ongoing process. Our research team in the States are continually doing more and more work on that. But in Australia, it's something that probably needs even more innovation, just because the council financing landscape, as far as I understand it, is quite different to the council financing landscape as it exists in the States. So there's a bit of an exploration process to be had there, and a lot of innovation happening in this space. One of the great things about the responsible and sustainable finance space is that there's a whole bunch of extremely passionate people working in it, trying to figure out how to get this capital moving. We have a very similar conversation often about startups. We talk to Energy Lab a lot. And the conversation of how do we connect interested investors with projects on the ground is the same conversation that we are often having in that forum as well. So to sort of round that out, I think there's an obvious interest from the institutional investment level here. I could talk about it all day. And there really is an interest in identifying new partnerships and new ways to invest. And there's a shortage of pipelines. So one of the things I didn't say is there's just not enough activity at the moment to fulfill the need for financing that we see, or the demand for financing that we see. And it's pretty obvious that a lot of the activities that councils undertake fit into these in a somewhat direct way. But there is that categorisation question, that classification question to work through, and there's going to have to be a lot of innovation in the space. So I think I've hit my 15 minutes. So I'm going to pause there.
Thanks, Zoe. That's great. Sounds like there's a lot of innovation and a lot of opportunity happening in this space internationally and potentially here as well. You mentioned that state governments here have issued green bonds. Auckland councils issued a green bond. Are you aware? Can local governments here issue green bonds? Do we know? And also, are you aware of any councils here in Australia at that council or local government level contemplating that?
Yeah, it's a good question. So I'm not aware of councils specifically contemplating it, but as I said, I'm not even a LGA finance type person. We operate at the institutional level, and I'm absolutely sure that there could be a number of conversations happening with respect to getting green bonds or getting the green loans together for councils that we are not aware of. There is in Victoria, the local government financing vehicle, I believe, which has often been flagged as being a kind of collective financing. Obviously, it is a collective financing option, but it is an option for green finance. But there are a whole bunch of other. We often think about green bonds when we think about this type of finance, but there are a whole bunch of other finance forms which are used as well. So there are quite a few social bonds that have been issued in Australia that have been issued in a partnership between an organisation operating at a local level, often a state government and a third party. Social Ventures Australia have done a few that sort of say we're going to deliver outcomes in a certain area and we're going to finance that, and we'll issue a bond for that particular project. So it's not the council issuing the bond, but it is a third party or a counterparty that's working with a local area. So it doesn't just have to be green bonds, although I do think that there are quite a few sort of promising structures that might facilitate that type of investment in the future.
Yeah. And as you mentioned, there is indeed a huge amount of activity happening at the local government level, much of which I'm sure would be attractive, given what you've outlined, the interest of investors being. Do you think it's at the right sort of scale for investors, or would there need to be some kind of aggregation potentially across local governments? Any thoughts on that?
Yeah, it's a really interesting question. So a lot of the existing issuance that you could see is the Climate Bonds Initiative have a great review of issuance that they produce every year in Australia that sort of categorises all the issuance. And a lot of those you can see are aggregated projects, even when you're doing it at a state level, or even in the case of Auckland, they really are aggregated issuance. So you've got a little project here, another project there, and you'll see it in the stack. It'll sort of say, 70% transport projects, 15% renewable energy projects, 5% water projects. And so there's already a very strong leaning towards aggregation of projects in the issuance pattern. I would expect, I remember Ernst & Young produced a report a long time ago, actually, about, it was quite a while ago now, about local government financing, talking about the scale that you would need to bother going through the rigmarole of issuing bonds, etc. And it is reasonably large scale. But nonetheless, I think the same report actually said that the local governments kind of would be advantaged by getting joint financing or collaborating to get sort of pooled financing. And that's certainly a model that we see operating in other types of sustainable finance activity, or even in offset production, right? It's quite common to aggregate projects and kind of bring them up to the investor scale.
Great. And look, one final question we'll just sneak in. I know we're slightly over time, but there are several councils around Melbourne who've completed feasibility studies to establish solar farms on former closed landfill sites. The only thing holding these councils back on developing the solar farms is the initial capital. Any thoughts on how councils can attract favourable finance to get these solar farms up and running?
It's a really good question. Because so much of this is about innovation and about getting projects over the line, at the moment, the industry, and we have this same situation with startups as well, actually. At the moment, the industry doesn't have like just go and talk to that issuer over there type of thing. There are a lot of people working really hard on it, but there's no kind of really established best practice system. And so what I would say to those people is probably, or to those councils, is the same thing that I would say to the startups, which is connect with the supers, because they are constantly looking for ways to gain exposure to these sorts of activities, even if they don't have those structures in place already. Everyone is innovating in the space. I remember Kat Tapley saying, I think a couple of years ago, that the ESG institutional investment space has a bit of innovation to do, but it tends to innovate faster than other areas, just because it's so, in some senses, it's growing so quickly, but it's also very purpose driven. And so it's becoming part of the conversation, and making sure that that need is visible in the conversation. And I would flag the IGCC as a really good forum for that, right? The IGCC has a lot of members who are not investors, but who are leaning into that conversation and wanting to understand how they can interact with those parties and form those partnerships.
Wonderful. Look, thanks again, Zoe. We are a little over time, so we'll get moving now, but thanks for taking the time to speak with us today.